Look, I've got a story that will make you sit up and take notice. A bold claim. The best investors, right now, can expect nothing from the federal. That's right, nothing. And it's a crisis that's shaking up the markets. So, what does this mean for your money? Well, by the end of this video, you'll understand the impact of this crisis, the key players involved, and why this is a major confidence issue for investors. Here's what's wild. A company called Strategy, with its CEO Alexander Bloom at the helm, is facing a major trust issue with retail investors. Strategy's stock, MSTR, has taken a hit, dropping 8% to $86, its lowest since February 2024. And its perpetual preferred stock, STRC, designed to trade near $100, is now at $75, a significant 25% discount. Let me be direct. This is a big deal, and it's not just about now pay attention because this is where it gets interesting. Strategy, despite these drops, still has the cash to cover its dividend obligations for almost 10 months. So, the question arises, why are investors losing faith? Well, it's a combination of factors. Here's the thing. Strategy's plans have changed repeatedly, and the weak performance of its stocks has left a bad taste in investors' mouths. And get this, the bigger issue is confidence, not solvency. MSTR's decline has traders worried, but it's not just about the immediate future. The company's enterprise multiple to net asset value, MNAV, is now at 1.05, a far cry from the premium it once enjoyed. This compression is a concern, and it's impacting Strategy's ability to fund its Bitcoin acquisition and engine efficiently. Benchmark analyst Mark Palmer previously noted that STRC trading below $100 makes it harder for the company to issue preferred shares on attractive terms. So, why is this happening? Let's break it down. Strategy, with its focus on Bitcoin, has seen its funding model take a hit. The perpetual preferred stock, STRC, was meant to be a stable, income-generating product, but its decline has shaken investor trust. The repeated changes in Strategy's plans, combined with the stock's poor performance, have left a mark. And while the company can meet its dividend obligations, the damage to investor confidence is real. The year is 2026, and the impact of these events is still being felt. Bitcoin ETF flows, a key indicator of investor sentiment, are a crucial part of this story. When investors buy or sell shares in Bitcoin ETFs, it creates inflows or outflows, impacting the market. So, the question remains, how will Strategy navigate this crisis and rebuild investor trust? That's the million-dollar question, and it's one we'll explore further in the next part of this series. Alright, so how do we get here? To truly understand the current predicament facing Strategy and its investors, we need to rewind the clock. 5 years ago, in the early days of this decade, the crypto landscape was a wild west, but also a land of immense opportunity and innovation. Companies like Strategy emerged with ambitious visions, aiming to bridge the gap between traditional finance and the burgeoning digital asset space. They promised stability and income, even launching products like STRC, the perpetual preferred stock, which was meticulously designed to trade near a stable $100 par value. The idea was simple. Offer investors a low-volatility income product, backed by the growing narrative of digital asset adoption, and build a robust funding engine around it. For a time, this strategy worked. The market bought into the vision, driving a high-flying premium that long underpinned the company's bull thesis. But fast forward to back in 2024, and the cracks began to show. The promise of stability started to falter, and investor trust, as CEO Alexander Bloom would later lament, began to erode. We saw MSTR, Strategy's primary stock, take a significant hit, falling 8% to $86. This wasn't just a minor dip. It marked its lowest level since February 2024, a clear red flag that something fundamental was shifting. Even more concerning was the performance of STRC. That preferred stock, meticulously designed to hold its $100 peg, completely collapsed to $75, a staggering 25% discount. This wasn't just poor performance. This was a direct blow to the core promise of the product. Bloom explicitly stated that repeated changes in Strategy's plans, combined with the weak performance of both MSTR and STRC, had severely undermined confidence among retail investors. This loss of faith wasn't merely about short-term price movements. It impacted Strategy's very operational efficiency. As benchmark analyst Mark Palmer astutely pointed out, STRC trading so far below its target level meant Strategy could no longer issue these preferred shares on attractive terms, making their Bitcoin acquisition and funding engine far less efficient. It wasn't an implosion, not yet, but it was a critical loss of leverage and a stark reminder that even in innovative markets, trust remains the ultimate currency. And now, here in 2026, we're dealing with the lingering fallout. Now, some might look at this situation and immediately draw parallels to past market meltdowns. Is this just another dot-com bust, where speculative assets and grand promises ultimately crashed back to earth? Or perhaps it's reminiscent of the 2008 mortgage crisis, where supposedly safe, low-volatility income products like complex mortgage-backed securities turned out to be anything but, leading to a profound loss of trust in the system itself. And in many ways, the human element, the fear and greed, the eventual panic when a perceived safe haven like STRC suddenly trades at a 25% discount, absolutely mirrors those historical precedents. The feeling of betrayal among retail investors who were sold on a low-volatility income product is a tale as old as time. However, to say this is just another one of those moments would be to miss the crucial nuances that make this time genuinely different. What's truly new here isn't just the underlying asset. Bitcoin, with its decentralized nature and global accessibility, fundamentally alters the playing field compared to traditional equities or real estate. It's also the innovative, albeit now struggling, financial engineering around it, with products like STRC attempting to create a stable income stream from a volatile asset class. The speed at which information or misinformation can spread globally and the immediate impact on something like Bitcoin ETF flows adds a layer of complexity that simply didn't exist in previous crises. While the loss of confidence in strategy echoes past failures, the intricate interplay of digital assets, novel financial instruments, and a hyperconnected global market creates a unique challenge. It's not just a matter of solvency. It's about the very fabric of trust in a new financial paradigm. And to truly grasp the depth of this situation, we need to get into the real numbers, dissecting the balance sheets and cash flows to understand exactly what Strategy's financial health truly looks like. All right, let's cut through the noise and get down to the hard numbers, because this is where the real story lies. We're talking about Strategy and specifically their financial health, which has become a major point of contention. First off, you've heard the headlines. MSTR fell 8% to $86, its lowest point since February of this year. That might sound alarming, but let's put it in perspective. It's a significant drop, yes, but it's crucial to understand the now. Here's what the data actually shows about their ability to meet their obligations. Despite STRC trading at that $75 level, Strategy still holds approximately $1.5 billion in US dollar reserves. This is a critical figure because it translates directly into their dividend runway. They have enough cash to comfortably meet their dividend obligations for almost 10 months. That means, based on current cash on hand, those dividend payments are not immediately at risk. Most people do not realize that while the market price of STRC has plummeted, the underlying cash supporting the dividends remains substantial for the near term. Another key metric is Strategy's enterprise multiple to net asset value, or MNAV. This currently sits at just 1.05. For a long time, Strategy traded at a significant premium to its NAV, which was a core part of the bull thesis. A multiple of 1.05 suggests the market is valuing the company at roughly its net asset value, a stark contrast to the premium it once commanded. This compression is a direct result of the loss of investor confidence, not necessarily a sign of impending insolvency. The fact that STRC's price is significantly below its $100 target level impacts Strategy's Bitcoin acquisition and funding engine. Specifically, it makes it harder and less efficient for them to issue new preferred shares on attractive terms, a point previously highlighted by analysts. This inefficiency, however, is distinct from a failure of the core business model. The issue is one of confidence, not solvency, at least for now. Let's look at the two sides of this coin, the bull case and the bear case. For the bull case to play out, Strategy needs to fundamentally rebuild investor trust. This means demonstrating consistent execution and transparent communication. The strongest bull argument hinges on the idea that the underlying assets and Strategy's operational model are sound, and the current market panic is an overreaction. If they can navigate this period of low confidence, perhaps by showing continued strength in their Bitcoin holdings and successfully managing their funding, the market could eventually re-rate STRC back towards its $100 par value. This would not only restore faith, but also re-energize their preferred stock issuance capability, allowing them to continue their strategy of acquiring Bitcoin. Essentially, the bull thesis relies on a restoration of market sentiment and a renewed belief in the long-term viability of Strategy's unique approach. On the flip side, the bear case is quite stark. What could go seriously wrong? The primary risk is a sustained loss of confidence that spirals into a liquidity crisis. If investors continue to flee STRC and the discount to par widens significantly, it could make it prohibitively expensive or impossible for Strategy to issue new preferred shares to fund its operations and Bitcoin acquisitions. This would starve the engine of growth. Furthermore, if Bitcoin itself experiences a significant downturn while Strategy is heavily leveraged or reliant on new funding, it could exacerbate the situation dramatically, potentially leading to a situation where they struggle to meet their dividend obligations even with their current cash reserves. The worst-case scenario involves a death spiral. Falling stock prices lead to funding issues, which leads to further stock price declines and ultimately, a failure to meet financial commitments. So which side is right? That depends on what you do with this next. Now, let's delve into for the long-term investor. This crisis may seem daunting, especially with the potential for a downward spiral. However, it's important to remember that your savings and investments are built for the long haul. While a 25% discount to par value for STRC may cause concern, it doesn't necessarily mean immediate trouble. Your portfolio's resilience lies in its long-term strategy and the ability to weather such storms. Still, it's wise to keep a close eye on your investments, especially if you have a significant portion allocated to strategy-related stocks. Short-term traders, on the other hand, might see this as an opportunity. A 25% discount could present a buying opportunity, especially if you believe in the long-term prospects of the company and its ability to navigate this crisis. However, it's a high-risk, high-reward scenario, and you must be prepared for potential losses if the situation worsens. For those with savings but no direct exposure to Strategy, this is a reminder of the importance of diversification. While your income and savings may not be directly impacted, it's a lesson in the potential risks of concentrated positions. Now let's get into a 90-day one. Monitor your portfolio closely, especially if you hold MSTR or STRC stocks. Set price alerts for when these stocks reach 10% below their current value. If this happens, consider reevaluating your position and potentially reducing your exposure. 2. Keep a close eye on Bitcoin's price. If Bitcoin experiences a significant downturn, it could exacerbate Strategy's situation. Set an alert for when Bitcoin drops below $30,000, as this could indicate a potential trigger point for further action. 3. Watch for any further declines in STRC's price. If it falls below $70, this could signal a more severe crisis, and you should consider reviewing your overall investment strategy. Indicators to watch. The enterprise multiple to net asset value, MNAV, ratio for Strategy. If this ratio falls below 1.0, it could indicate a severe compression in the company's valuation. The US dollar reserves of Strategy. If these reserves drop below 6 months' worth of dividend obligations, it could signal a potential funding issue. The performance of MSTR. If it continues to decline and falls below $80, it may indicate a broader loss of confidence in the company's ability to recover. Stay tuned as we delve into the big picture and explore the broader implications of this crisis in the next section. Certainly, here is the content for the final sections of your video script. As we zoom out and consider my bold prediction is that we are on the cusp of a market reset, a necessary correction that will redefine the investment landscape for the next decade. This crisis, if not addressed swiftly and effectively, could lead to a prolonged period of uncertainty and volatility. Investors who recognize this early and adapt their strategies accordingly will be well-positioned to navigate the upcoming challenges and potentially capitalize on new opportunities. It's crucial to understand that this is not just about individual companies or sectors. It's about the broader economic forces at play. The market is sending signals, and those who can interpret them will be ahead of the curve. Now, let's recap the key takeaways from today's discussion. We've explored the potential severity of the current crisis and the indicators to watch, including the MNAV ratio, US dollar reserves, and MSTR's performance. We've discussed the importance of reviewing investment strategies and being prepared for various scenarios. Additionally, we've highlighted the need to stay informed about economic trends and their impact on the market cycle. The next 90 days are going to be critical. Investors must remain vigilant and adaptable. The market is dynamic, and those who can navigate these challenging times will emerge stronger. If you found this breakdown valuable, subscribe. We drop new finance videos every day. And watch our other videos to stay ahead of the market. Follow for more information.